Have you ever settled a debt only to find yourself still paying interest on money you no longer owed? This surprising scenario was once a standard practice. Imagine clearing most of your credit card balance, then checking your next statement expecting minimal interest. Instead, you're hit with charges on funds you'd already repaid. This wasn't some banking error or a system glitch, it was a deliberate and established rule. Before 2009, many credit card companies employed a controversial method known as double-cycle billing. Here's how this system operated. Rather than basing your interest on your current outstanding balance, banks used a different calculation. They would average your balance across not one, but two billing cycles, the present month and the month prior. Let's consider a practical example to clarify this confusing practice. Suppose you had a $5,000 balance last month, but then diligently paid it down to just $500 this month. Naturally, you'd anticipate paying interest only on that remaining $500. However, under double cycle billing, the bank combined both months' balances. They added $5,000 and $500, then divided by 2, resulting in an average of $2,750. So, you were charged interest on $2,750, even though $4,500 of that was money you had already returned. At a typical 18% APR, this meant an extra $41 in interest on funds you no longer borrowed. Multiply this across millions of cardholders monthly, and the industry was secretly accumulating billions in these unnoticed phantom interest charges. Fortunately, the Credit Card Act of 2009 completely outlawed this method. Congress recognized it had quietly siphoned money from Americans for years, penalizing the very act of paying down debt. Beyond that, another ethically questionable tactic known as universal default began to surface, further complicating financial stability for consumers. Imagine having 3 credit cards where you consistently made payments on 2, yet you slipped up by being 5 days late on the 3rd. Perhaps you were traveling or simply overlooked the due date, but the consequence was immediate and widespread. The following month, not just the card you were late on, but all 3 banks dramatically increased your interest rates. Prior to 2009, credit card agreements often granted banks the power to hike your interest rate if you defaulted on any financial obligation. This could be a different credit card, a car loan payment, or even just a utility bill that was paid late. A single oversight anywhere in your financial life could cause every credit card you own to suddenly jump to a punitive rate. What made this practice particularly egregious was its truly predatory nature and how it operated. The elevated interest rate was applied retroactively, meaning it affected your existing balance, not just new purchases. Consider buying a laptop in January with a favorable 12% APR, then inadvertently missing a phone bill in March. Suddenly, that same laptop you purchased months ago would be subjected to an astonishing 29.99% interest rate. This was a purchase made under entirely different agreed-upon terms, now drastically altered due to an unrelated error. To illustrate the financial impact, let's consider a balance of $10,000 at an initial 14% APR. With universal default, that rate would instantly skyrocket to 29.99%, significantly increasing your financial burden. For those making only minimum payments, such a substantial rate jump would drastically extend the repayment period and total cost. A minor misstep, such as a late utility payment, could trigger this extreme penalty. Even a single financial oversight meant all your credit card accounts could instantly jump to a punitive rate. What truly made this practice predatory was its immediate, retroactive application to your existing debt. The increased interest rate wasn't just for new purchases, it also applied to your entire existing balance. Imagine securing a new laptop with a reasonable 12% APR in January, a purchase under clear terms. Then just a couple of months later, you accidentally miss an unrelated phone bill payment. Suddenly, that previous laptop purchase, made under different terms, was now subject to a staggering 29.99% penalty rate. Thankfully, the Card Act of 2009 intervened, effectively abolishing both universal default and these unfair retroactive rate hikes. While banks still possess the ability to adjust your interest rate, new regulations dictate it only applies to future transactions. Furthermore, they must provide a 45-day advance notice, and only after your account has been active for at least 1 year. But universal default wasn't the only deceptive practice. Consider the shocking reality of negative amortization mortgages. Picture making every single mortgage payment diligently, on time, for 3 consecutive years. Yet, despite your perfect payment history, you somehow owed more on your home than your initial principal. This wasn't a hypothetical scenario. Millions of Americans faced this harsh reality during the mid-2000s. Lenders offered these negative amortization products, where your monthly payment was intentionally set below the accruing interest. The interest not covered by your payment didn't vanish. Instead, it was simply added to your loan's original principal. This meant that with each payment you made, your total outstanding debt paradoxically increased rather than decreased. To illustrate, consider a borrower securing a $350,000 mortgage with an interest rate of 6.5%. A standard, fully amortizing payment for this loan would be approximately $2,212 each month. However, the lender presented an attractive minimum payment option of just $1,100, which seemed like a fantastic deal. That substantial difference of $1,112, which wasn't paid, was then added back to the loan's principal every month. Consequently, after 3 years of consistent, on-time payments, the borrower's debt had grown from $350,000 to an astonishing $390,000. Despite their faithful adherence to the payment schedule, they found themselves $40,000 further in debt. As long as housing prices continued to climb, this insidious debt growth largely went unnoticed by many. Most borrowers simply expected to refinance their homes before the higher, fully amortizing payments would eventually begin. However, the housing market collapse in 2007 and 2008 revealed a harsh truth. Millions of homeowners were now underwater, owing more than their property was worth. This left them with no options to refinance their loans, and tragically, no apparent escape from their growing debt. In response, the Dodd-Frank Act of 2010 was enacted, effectively prohibiting negative amortization by mandating a qualified mortgage standard. This new standard ensured that a borrower's monthly payment would genuinely reduce the loan principal, rather than allowing the debt to expand. Beyond this, no-doc or liar loans were common. A pizza delivery driver earning $28,000 annually could be approved for a $440,000 home, with no income verification. The approval process for these loans was incredibly lax, often requiring little to no verification of income or assets. While careful underwriting used to take a week, some lenders could now greenlight a mortgage in a mere 30 seconds. The financial incentives clearly explained why this speed was prioritized. A broker could earn $8,000 to $12,000 in fees and commissions from a single $400,000 liar loan. Within weeks, this loan would then be packaged and sold off to Wall Street as part of a mortgage-backed security. This meant the original lender had already profited long before any borrower defaulted, effectively shifting all risk onto others. Unsurprisingly, when home prices plummeted, these liar loans failed at an alarming rate, as borrowers couldn't sustain payments on their exaggerated incomes. These particular loans significantly fueled the 2008 financial crisis, which ultimately erased an estimated $7 trillion from American home equity. To prevent a recurrence, Dodd-Frank's ability to repay rule now strictly mandates that lenders verify income, employment, and debt for all mortgage approvals. The era of simply scribbling a number on a napkin to secure a $500,000 loan is definitively over. Another questionable practice involved yield spread premiums. Imagine entering a broker's office with excellent credit, qualifying for a 5.5% interest rate. However, the broker might silently place you into a 6.5% loan because lenders offered a concealed bonus for directing clients to higher interest rates. This hidden incentive was known as a yield spread premium, and its financial mechanics were quite straightforward. Lenders distributed rate sheets indicating that for every quarter-point increase above the standard par rate, the broker would receive a percentage of the total loan amount. For instance, on a $300,000 mortgage, raising the rate from 5.5% to 6.5% could secretly net the broker an additional $6,000 to $9,000. This sizable sum was a hidden compensation, directly at the borrower's expense. The broker's additional earnings were on top of any other direct fees already levied against the borrower. Unaware of these hidden charges, borrowers placed their full trust in the broker to secure the most favorable interest rate. However, the broker's financial incentives directly contradicted this trust, pushing them to act against the borrower's best interest. To fully grasp the impact, let's examine the long-term financial consequences of that single percentage point increase over a 30-year period. For a $300,000 mortgage, moving from 5.5% to 6.5% meant the borrower would pay an astonishing $67,000 more in total interest. This staggering sum represented a significant unadvertised financial burden over the entire duration of their loan. While the broker pocketed a relatively small bonus of around $6,000 at closing, the borrower faced decades of inflated payments. Such practices were far from isolated incidents. This type of bonus was quite common in the industry. In fact, over 85% of subprime mortgages incorporated these yield spread premiums. Brokers typically garnered more than $1,000 for each loan, where they guided clients toward more expensive financial products. Disturbingly, this predatory lending disproportionately affected borrowers from minority communities. Regardless of their creditworthiness, African Americans and Latinos frequently received loans with significantly higher interest rates. They were more than 3 times as likely to be subjected to these elevated rates compared to white borrowers with identical credit profiles. Recognizing the unfairness, the Federal Reserve finally outlawed yield spread premiums in 2011, a ban later reinforced by the Dodd-Frank Act. Although brokers can still earn compensation, they are no longer permitted to manipulate interest rates to increase their personal profit. However, this wasn't the only deceptive practice. Another product was known as single premium credit insurance. Imagine you're at a car dealership having just agreed on a price and monthly payment for your new vehicle. As you sign the final documents, a hidden charge for credit insurance is discreetly placed on page 9. No one bothered to explain what it was, nor did anyone ask if you actually wanted this additional coverage. Despite the lack of consent, this cost was rolled directly into your auto loan, meaning you'd pay interest on it for years. Ostensibly, this insurance was meant to cover your loan payments if you faced death or became disabled. In reality, its primary function was to safeguard the lender's investment, often at an exorbitant price to the borrower. This type of insurance was notoriously overpriced, offering little genuine value for its steep cost. Consider a common scenario. A person takes out a $15,000 auto loan for a new car. The lender, at the time of closing, quietly adds a $1,200 single premium credit insurance policy. This additional $1,200 is then immediately folded into the principal amount of the loan. Consequently, the borrower isn't financing $15,000 anymore, but rather an inflated $16,200. With an 8% interest rate over 5 years, that initial $1,200 policy ends up costing the borrower around $1,500. This significant extra expense was for a policy that seldom resulted in a payout when claims were made. Furthermore, many borrowers were completely unaware that purchasing this credit insurance was entirely optional. The most egregious aspect was the substantial commission lenders typically pocketed from these insurance premiums. They often earned between 40 to 50% of the policy's value. For instance, on a $1,200 policy, the lender would personally gain $500 to $600. This profit was secured even before the borrower made their very first loan payment. Clearly, this product wasn't designed to protect the borrower's interests. Instead, it functioned as a hidden profit engine, cleverly embedded within the overall loan structure. In response to these abuses, federal regulators in several states began taking action in the early 2000s. The Dodd-Frank Act specifically banned creditors from financing single premium credit insurance on covered mortgage loans. While this particular form of the practice has largely vanished for mortgages, it still exists for smaller consumer loans. However, the most predatory versions, mandatory, undisclosed, and rolled into your mortgage, are thankfully gone. This kind of deceptive practice isn't new. Consider the bucket shops of 1902. Imagine stepping into a Wall Street establishment designed to mimic a legitimate brokerage firm. Inside, you'd find a ticker tape, stock prices on a chalkboard, and agents ready to take your investment. You might wager $50, betting on a rise in U.S. Steel shares, for example. However, your funds never reached the actual market. The shop simply took the opposing side of your bet. If your prediction was incorrect, your capital was simply forfeited to the house. Should you have been right, payment was entirely at their discretion, often withheld. These dubious establishments, known as bucket shops, became widespread across the nation. They thrived throughout the late 1800s and into the early 1900s, appearing in countless towns. They offered ordinary individuals the illusion of stock market participation, but without any genuine exchange protections. The proprietors fully understood that most of their clientele would inevitably incur losses. Their business model was therefore remarkably simple: accept all wagers and retain the majority of the invested funds. The sheer volume of their operations was truly staggering for that historical period. At their peak, it's believed that bucket shops managed more trading activity than the New York Stock Exchange itself. Jesse Livermore, one of America's most renowned traders, faced bans from several of these shops. He wasn't accused of cheating, but rather of winning too consistently, thus draining their profits. States began to outlaw these operations in the early 20th century, seeking to curb their predatory practices. New York, for instance, specifically declared them illegal in the year 1908. However, the decisive blow came with the Securities Exchange Act of 1934, which established the SEC and mandated regulated exchanges. Although bucket shops are now prohibited, some observers argue that their exploitative model never truly vanished, but simply evolved. While some economists note potential similarities in how modern trading apps route options orders, suggesting a deeper conversation, that topic is for another time. Instead, let's turn our attention to another infamous scheme: the penny stock pump and dump. Imagine your fax machine suddenly printing an unsolicited newsletter, touting a tiny company called MedTech Solutions. It boldly claims this obscure firm is on the verge of being acquired for 10 times its current trading price. At that moment, the stock itself is valued at a mere 12 cents per share. As you review the facts and check the live price, you notice it's already beginning to climb. Convinced by this seemingly urgent opportunity, you quickly invest $5,000. However, just 2 weeks later, the stock plummets back to a single penny. Your initial $5,000 investment is now worth a mere $400. Meanwhile, the individual responsible for sending that enticing fax has pocketed a staggering $2 million. This classic maneuver is known as a pump and dump. For many decades, it stood as one of the most consistently effective frauds on Wall Street. The mechanism is straightforward. A promoter first acquires millions of shares of a nearly worthless penny stock at an incredibly low cost. They then unleash a flood of deceptive hot tip newsletters, initially via fax machines, and later through email and online message boards, aggressively hyping the stock. This manufactured excitement prompts ordinary investors to buy in, thereby artificially inflating the stock's price. Upon reviewing the seemingly compelling facts and witnessing the stock's initial ascent, an investor becomes convinced. They decide to commit $5,000 to this promising opportunity, only to see its value plummet. Within a mere 2 weeks, the stock's price collapses back to a single penny, rendering their $5,000 investment worth a paltry $400. Meanwhile, the orchestrator of that initial promotional fax has successfully reaped a profit of $2 million from the same scheme. Once the artificially inflated price reaches its peak, the promoter swiftly executes the dump phase, liquidating all their shares and disappearing. Consider, for instance, a promoter who acquired 10 million shares of a worthless penny stock for just a penny each, totaling a $100,000 investment. After their aggressive pump campaign drives the stock's price to 50 cents, those same shares are suddenly valued at $5 million. The promoter then sells them off, pocketing a staggering $4.9 million in profit. This massive sell-off inevitably causes the stock to collapse, leaving subsequent investors with significant losses. Every single dollar earned by the promoter in these schemes comes directly from the regular investors who bought into the fabricated hype. Recognizing the danger, the SEC began to tighten penny stock regulations throughout the 1990s and 2000s. They introduced stricter disclosure requirements, placed restrictions on cold calling, and implemented suitability rules for investments. However, the fundamental pump and dump scheme continually adapts, migrating from faxes to email, then social media, and even into the realm of cryptocurrency. The SEC has pursued cases where promoters amassed tens of millions before a single charge could be filed, as the schemes often move faster than enforcement. Let's now turn to another form of financial manipulation called churning, illustrated by a 68-year-old retired teacher who entrusted her $250,000 savings to a stockbroker. An elderly retired school teacher, aged 68, entrusted her life savings of $250,000 to a financial broker. Her clear instruction was to invest for secure, consistent income, prioritizing safety above all else. However, over the course of the following year, this broker executed an astonishing 187 trades within her account. By the year's end, the value of her investment portfolio had dwindled significantly to just $214,000. In total, the teacher suffered a substantial loss of $36,000 from her hard-earned retirement funds. Yet for the broker, this period proved highly lucrative. He personally collected $31,000 in commissions. This unethical practice, where a broker excessively trades a client's account for personal gain, is known as churning. It occurs when investments are bought and sold not for the client's benefit, but solely to generate more trading fees for the broker. Regardless of whether a trade improves the client's position, each transaction directly deposits money into the broker's account. The mathematical reality behind churning reveals its truly insidious nature and devastating impact on clients. Consider a 1.5% commission per trade. 187 transactions on a $250,000 account could easily siphon over 12% of the portfolio's value in annual commissions. To put this into perspective, the S&P 500's average annual return typically hovers around 10%. This means the broker was extracting more in fees than the entire market generally yields in a year. With such exorbitant costs, the client's investment portfolio was destined to fail from the outset. Churning has always been legally classified as fraud under securities law, yet effective enforcement was historically challenging. For decades, it was difficult to detect excessive trading, as brokers could always justify each individual transaction. The situation shifted dramatically, however, once digital trading records allowed for the calculation of a new metric, the turnover ratio. This ratio specifically measured how frequently a client's entire investment portfolio was bought and then sold within a single year. Nowadays, FINRA automatically scrutinizes investment accounts, promptly flagging brokers who exhibit unusually high turnover rates. Furthermore, the emergence of fee-only financial advisors and the popularity of index fund investing have made it increasingly difficult to conceal churning practices. For many decades prior, however, this was among the simplest methods for brokers to deplete client accounts, all while appearing to diligently perform their duties. Our next exploration delves into a distinctively complex scheme known as the son of boss tax shelter. Imagine a successful businessman who sold his company, netting a substantial $50 million from the transaction. Consequently, he faced a hefty tax obligation to the IRS amounting to approximately $10 million in capital gains. His accountant from one of the nation's most prominent firms presented an enticing proposition. There's a perfectly legal method to entirely eliminate that tax burden. The accountant continued, for a fee of $500,000, our firm can establish a partnership framework that will generate $50 million in artificial paper losses, effectively canceling out your entire gain. This meant that, on paper, the businessman would appear to have made no profit, yet in reality, he would retain his $50 million and pay absolutely no taxes. This elaborate maneuver was infamously dubbed the son of boss, an acronym derived from bond and option sales. This intricate financial structure was expertly designed to create an illusion of losses where none truly existed. It served as a highly sophisticated tax shelter, enabling immense profits to go completely untaxed by authorities. Such strategies highlighted a significant loophole in the tax system that certain individuals and firms exploited. The son of boss strategy wasn't an isolated incident. It was actively promoted by major accounting, law, and investment firms throughout the late 1990s. While the underlying financial mechanics were incredibly intricate, the ultimate outcome for its beneficiaries was straightforward. Affluent individuals could effectively eliminate their genuine capital gains by fabricating partnership losses on paper. The sheer magnitude of this tax evasion scheme was truly astonishing once it came to light. The IRS eventually uncovered more than 1,800 taxpayers who had utilized these son of boss shelters. Collectively, these schemes resulted in over $6 billion in undeclared tax liabilities. It's crucial to emphasize that this figure was in the billions, not just millions, underscoring the vast scale of the issue. Many individual participants had reported fictitious losses ranging from $10 million to $50 million. Remarkably, some cases even saw claimed losses surpassing an astounding $500 million. The Internal Revenue Service initiated a major crackdown on these practices in the year 2000. This was followed by the launch of a comprehensive settlement initiative in 2004 to address the widespread evasion. Settlement terms were harsh: concede all claimed losses, pay back taxes plus interest, and face a 10 to 20% penalty. Despite these severe penalties, a significant two-thirds of the participants chose to come forward and settle their cases. By 2005, the aggressive IRS efforts had successfully recouped more than $3.2 billion from these settlements. Average settlement payments neared $1 million, with 18 taxpayers each paying over $20 million, and one individual's payment exceeding $100 million. However, it wasn't only the taxpayers who faced repercussions. The very architects of these schemes, the promoters, also had to answer for their actions. KPMG, a global accounting giant, confessed to creating at least $11 billion in fraudulent tax deductions through these arrangements. As a result of their involvement, multiple partners from the prestigious firm faced formal charges and indictments. The law firm Jenkins & Gilchrist, instrumental in structuring many of the son of boss transactions, ceased operations completely. Moreover, two key partners from Jenkins & Gilchrist were ultimately found guilty of tax evasion for their role. Beyond the individual convictions, the son of boss scheme inflicted a substantial $6 billion loss upon the U.S. Treasury. More critically, it exposed a disturbing truth. Even America's most esteemed financial institutions were ready to concoct elaborate fiscal deceptions. These prominent firms actively constructed and marketed intricate financial fictions to clients, all for a significant profit. In response, the controversial tax shelters were permanently dismantled, effectively closing off these avenues for avoidance. Furthermore, the existing accounting regulations underwent a comprehensive revision to prevent similar abuses in the future. Yet despite these significant changes, the fundamental ethical dilemma brought forth by Son of Boss continues to resonate. It forces us to ponder, if the most brilliant minds are devising ways to pay nothing, who ultimately bears the cost? When those with immense financial acumen systematically avoid their obligations, the burden inevitably shifts elsewhere. This story serves as a stark reminder about the complexities of financial ethics and the constant pursuit of fairness. If you found this deep dive into tax schemes insightful, please consider subscribing for more financial investigations and analyses.